I'm Natalie MacDonald, and it's time for a Targets in Focus interview where we ask a market insider for their forecasts on some of the major currency pairs. On the phone with me today is Stuart Frost, Head of Absolute Returns and Currency at RWC Partners in London. Thank you for joining me today, Stuart. Now, data-wise, this is a relatively quiet week. However, with ongoing Eurozone pressures and concerns over Chinese growth stimulus, what have been the key game changers in the currency markets this week?
Arguably, it's the same old thing, really, about Europe. Europe is the main issue here, and we've seen euro-dollar pressing towards these lows, towards 126 figure. It's been a little bit of a bounce, but that's more, I think, to do with these sort of European meetings that we're seeing at the moment coming through on Wednesday. So a bit of consolidation, if not profit-taking, but really the main issues remain around US dollars, euros, and also emerging market currencies, which have come under quite a bit of pressure, notably Brazil, Hungary, Rand, Mexican peso. There are real question marks over EM, I think, at this stage in the game. And really, I think the market is more leaning towards being long US dollars overall. Euro on the downside, unfortunately, has been a little bit slow. I think there's a lot of factors going on there, not least of which is probably European repatriation back into euros, obviously with so many debts and problems in the banking community. And that's likely to persist. So really, the week has been a little bit of consolidation, but the problems are still there, and the main currency at the moment remains the US dollar and arguably sterling, sort of safe haven currencies.
Euro-pound edged down today ahead of UK indicators. The British CPI data has come in better than expected, and with a flood of data coming out from the UK and Europe today and the European summit taking place in Brussels tomorrow, what are your predictions for the euro-pound?
Well, on euro sterling, we still actually see euro weakness. So on a 1 month basis, we're looking at 82 figure. So that represents a bit of consolidation after hitting this key psychological level of 0.80, which we last saw many years ago. So really, I think that from a 3 month perspective, we'll push on back towards 0.80 and then 0.77. in 12 months' time. So that represents euro weakness. That is a clear trend to us as far as we can see. We are moving back to that period of 2008 when we had a little bit of consolidation range between 78 and 80. And as you rightly say, the data this morning was really quite supportive of sterling. I know that you could say that higher rates are more supportive, but the fact that inflation is cooling, I also do believe that that's a good sign and will actually suck more people into the pound. So I think that was a major concern that this morning a lot of rumours flying around that the inflation data might come out a bit too high, and it didn't.
The pound US dollar has had a difficult couple of weeks, losing over 400 pips in a straight fall. We mentioned already a lot of data coming out of the UK, which seems to have brought the pair into a narrow trading range. The SNB have recently announced that they are diversifying into the pound, consolidating notions that a lot of money from Europe and Switzerland is being pushed towards the sterling. With this in mind, what do you make of claims that the pound is now being oversold, and how does this shape your forecasts on the pound US dollar?
Well, I don't think sterling is certainly oversold. If you look at the last few years, we've really been consolidating around 160. Nothing much has changed there. I mean, you could say that there are many reasons why sterling dollar should be a lot lower, particularly on an economic front. But we look at it on the basis of the sort of 1 month forecast of 160, which is a little bit higher from where we are at the moment this morning. 3 months 161, and looking at 12 months 165. We are in an Olympic year. That does suck in inevitable amounts of foreign exchange. That will be supportive of sterling. That's very often overlooked as an economic reason, but there's no doubt that with figures out retail sales, etc., look to be on the strong side. And I think really sterling is looked at as a safe haven currency and will remain that way. If you've got the Swiss National Bank buying sterling, that's quite a supportive factor, to say the least. And then you've got to say to yourself, well, who else is buying sterling from the central bank perspective? So we see sterling dollar quite supported on any dip down. So we see this opportunity, a little dip in sterling, as an opportunity to buy the currency. And certainly I think that the data will be mixed, admittedly, in the UK. The economic data is very mixed, but you've still got that underlying factor. Given the problems in Europe, which are quite considerable, that central banks will be tempted to diversify into currencies such as sterling and US dollars.
And finally, Stuart, the New Zealand dollar has picked up after a fortnight of falls against its US counterpart, shrugging off soft New Zealand inflation data. How is this pair looking in the short, mid and long-term period?
Well, certainly Kiwi is looking a little bit softer on the sort of long-term predictions. We're seeing quite a big sell-off in New Zealand dollars against US. We've been looking for a little bit of consolidation short-term in the 1 month, probably around 0.77 figure. But looking out 3 months, out to 12 months, I think really 74 is achievable on 3 months rate and 12 months 69. The New Zealand government probably want to see a weaker currency. It's been excessively strong over the last 3 years. They would probably be quite happy to see those figures. Interestingly, there's quite a good correlation between New Zealand dollars and milk prices. Obviously, New Zealand is an agro-economy. Also, the weakness in the Australian dollar and the Australian economy obviously will feed through into New Zealand, and indeed sort of cooling off in China. So we generally expect the New Zealand dollar to weaken and stay on that soft side of things. That doesn't mean to say or preclude that there couldn't be some rallies here, but we as a firm and a fund would objectively look to sell the New Zealand dollar against what we perceive to be resistance levels. That could be 0.80, as high as that. Really leaning towards selling this currency, but not looking for an excessive move down to say 0.60, just sort of modest weakness in the next 12 months.
Great insight there, Stuart. Thank you very much. That's all we've got time for today, but stay tuned to Dukascopy TV for all the latest analysis reviews and more exclusive interviews. Goodbye for now.